Here's a setup you don't see often. A specialty fintech beats on the top line, beats on the bottom line, raises full-year guidance, and trades at 184.93. The street's mean target, 167.
So the stock is roughly 10% above where the average analyst thinks it should be, after a beat and raise. That's the contrarian tension on the table today.
WEX Inc., ticker WEX, printed Q1 yesterday. Revenue $673.8 million, up 5.8%. Adjusted EPS $4.15 versus a consensus of $3.88, a clean beat. And yet JP Morgan, Barclays, BMO, and Mizuho have all been trimming ratings over the past 4 months.
Which means either the street is wrong or there's something the print didn't fix. Let's work through it.
WEX is a specialty fintech headquartered in Portland, Maine, a company that traces its roots to 1983, when it was founded as Right Express to solve a very specific problem, giving commercial fleets a clean way to pay for fuel.
40-plus years later, it's a 3-segment business. Mobility, which is the fleet card legacy, came in at $344.6 million in Q1, up 3.2%. That's 51% of revenue.
Corporate payments contributed $113 million, up 9.3%, roughly 17% of the mix. And benefits and health delivered $16.2, up 8.5%, at 32% of revenue.
The moat is the piece investors sometimes underweight. WEX's proprietary acceptance network reaches 95% of U.S. fuel stations. Deep API integrations into fleet telematics, multi-year enterprise contracts on the benefits side. Switching costs are genuinely high.
5,700 employees, about 28.7 million diluted shares, market cap $5.31 billion. Not a mega cap, a focused compounding fintech that's quietly globalized into Europe and Australia. Running the show is Melissa D. Smith, chair and CEO since 2014. She's not an outside hire parachuted in. She joined WEX in 1997 and was CFO before taking the top seat.
Under her watch, 15-plus acquisitions, including $1.7 billion in benefits platform deals that rebuilt the health segment, international expansion into Europe and Australia, and in January of this year, the company launched the industry's first unified EV plus fuel fleet card.
That last one matters. That's a CEO reading the secular risk to her own legacy business and building the bridge before anyone forces her to. Let's get into the print. Q1 revenue $673.8 million versus the street at $660. Adjusted EPS $4.15 versus $3.88. Both lines beat and EPS grew 18.2% year over year.
Management raised full-year guidance, revenue now $2.82 to $2.88 billion. Adjusted EPS $19, bracketed between $18.95 and $19.55. That's a confident guide post-Q1.
TTM revenue is running around $2.57 billion. Operating cash flow roughly $690 million. Free cash flow $618 million. This is a genuine cash generator.
On the valuation stack, the stock at $184.93 puts it at 25.3 times trailing, roughly 9.6 times forward on the midpoint adjusted number. The forward EPS projection of $19.25 at the midpoint anchors that multiple, PS 2.02 times, EV/EBITDA around 9.8, beta 0.93, defensive.
Margins, gross 62.5%, operating 18.2, net 11.4, ROE 14.8. The one line that gives bears oxygen, net debt $2.8 billion on a $5.31 billion market cap, 3.3 times net leverage.
No dividend, but there is a $2.0 billion buyback authorization outstanding, which on this share count is material.
11 analysts cover the name, 2 buys, 7 holds, 2 sells, mean price target 167.
Which again sits about 10% below yesterday's close. That is a rare configuration. Usually price chases target. Here, price has left target behind.
And the recent revisions lean one direction. JP Morgan downgraded to underweight in April, Barclays to equal weight in March, BMO Capital to market perform in February, Mizuho to neutral in January.
4 cuts in 4 months, through a quarter that beat. The street is telling you something, or it's behind the ball. That's the fork in the road for this name.
4 pillars on the bull side. 1, the unified EV plus fuel fleet card launched in January. It's the first card in the industry accepted at both gas stations and EV chargers. It doesn't just defend the moat, it extends it into fleet electrification.
2. Benefits and health. 8.5% growth in Q1, the fastest of the three segments, with essentially zero fuel price sensitivity. That's structural diversification showing up in the numbers.
3. The guidance raise, 2.2 to 2.88 billion in revenue, 19-ish in adjusted EPS. Management doesn't raise a full-year guide in April if they don't see the pipeline.
4. Capital return. At roughly 9.6 times forward-adjusted EPS, a 2.05 billion buyback is deeply accretive per share. This is a company using its multiple compression against the street.
The bear case is equally coherent. 1. Fuel price sensitivity. A 10-cent per gallon decline in retail fuel costs the business roughly $20 million in revenue and 35 cents of adjusted EPS. Mobility is still 51% of the top line.
2. Fleet electrification. If commercial fleets electrify faster than WEX's transition curve, fuel transaction volumes erode secularly. The EV card hedges this. It doesn't eliminate it.
3. The analyst picture. Targets below the stock, 2 outright sells, and a clear beat didn't generate a single upgrade. That's a signal the street thinks the multiple is stretched relative to growth.
4. The balance sheet. 2.8 billion net debt on a 5.3 billion cap. 3.3 times leverage constrains the M&A engine that's driven historical growth, and rising rate refinancing is a real interest expense headwind.
On the comp sheet, WEX's rivals split into 2 buckets, the fleet card side and the benefits side.
In fleet cards, Corpay, ticker CPAY, the old FleetCor, is the direct comparable, roughly 4.53 billion in revenue, growing 13.6%, trading at 4.85 times sales. WEX at 2.02 times looks cheap, but Corpay is growing more than twice as fast.
Global Payments GPN sits at 1.52 times sales, growth around 2.8%. Lower multiples, slower growth, not a perfect comp, but a useful reference point.
On the benefits side, Paychex trades at 7.2 times sales on 4.1% growth, ADP at 4.8 times on 6.2%. WEX's benefits segment is growing faster than both, but it's bundled inside a fleet card wrapper, so the market doesn't give it the pure play multiple.
Translation: WEX is cheap on absolute multiples, but the discount is partly earned by slower blended growth and segment mix. Options picture. Put-call ratio isn't cleanly available for the name, so we'll flag that as not reported.
Post-earnings implied vol compressed, which is typical. Flow is two-sided. Call activity clustered at 190 to 200 strikes, put spreads being built at 170 down to 160. So the market is bracketing the contrarian setup.
Insider activity leans to the sell side. CEO Melissa Smith sold 3.2 million in options across Q4 last year and Q1 this year. CFO David Tarrant sold 740,000 in March. Both look like planned diversification rather than conviction signals.
What's more telling, no open market insider purchases in 18 months. Nobody inside the house is leaning into the stock at these levels.
So where does this leave us? WEX printed a clean beat, raised the guide, and is executing on the EV fuel bridge. The fundamentals are fine.
The debate isn't about execution. It's about whether the current multiple already prices in that execution, and then some, given 5.8% blended growth, 3+ turns of leverage, and a mobility segment exposed to both fuel prices and long-run electrification.
The street has answered that question with 4 downgrades and a target 10% below spot. The stock has answered by ignoring them.
One of those 2 is wrong. The next 2 prints will tell us which.
2 metrics we're watching into next quarter. First, benefits segment growth rate. It came in at 8.5% in Q1. If it holds above 8%, the diversification thesis, that WEX is not just a fuel card company, gets real validation.
Second, any quantitative disclosure on EV fleet card adoption, card counts, transaction volumes, charging network coverage. Management hasn't broken it out yet, but it will surface in future earnings commentary, and that's the line item that tells us whether the January launch is a product or a platform.
That's our look at WEX, a beat and raise into a skeptical street, a contrarian tape with a real debate underneath it. For show notes, the full data pack, and our research archive on every name we cover, head to chargedalpha.com. If this episode helped you think more clearly about this name, share it with one person who cares about capital allocation as much as you do. Until next time, stay charged.
Stay charged. This episode is for informational and educational purposes only and should not be construed as financial advice, investment advice, or a recommendation to buy or sell any security. All investments carry risk, including the potential loss of principal. Past performance is not indicative of future results. The hosts may hold positions in the securities discussed. Listeners should conduct their own research and consult a qualified financial advisor before making any investment decision. Charged Alpha is an independent media production and is not affiliated with any company or security mentioned in this episode.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall